Now, just to give you guys an understanding, um, there is a strategy or a style of trading called auction market. Now, you guys don't have to study this. You don't have to subscribe to this. But what we have to understand is that the markets are a live auction. The price is going to go up to the highest bidder. So who's ever willing to pay this price up here, this is where the price is going to go to. The price will also travel down to the lowest seller or whoever has the cheapest price. So we want to keep these factors in our mind when we're trading. Um, it's going to give us an understanding or a scope of how the markets actually run or what makes the markets efficient. What price is always looking for is an equilibrium. It's going to be looking for a value point to where buyers and sellers can temporarily agree at. So this is where we get these moves at, and the market is trying to find a balance. Now, with auction market theory, what we're going to be looking for, or to give you guys a breakdown, the market is ran off of what we call supply and demand. It's going to be like any other business. I use an example of like an iPhone. When the iPhone first came out, there was a lot of demand for it, so price was sky high. As everybody started getting it, and the retailers started, manufacturing more iPhones, you'll notice that the price goes down and down and down because there's not as much demand for the actual iPhone. Now, as long as there's demand for, the actual product or currency in our land, then you're going to see price continue to travel up. That's going to be the reason that I don't subscribe to any oversold or overbought or oversold areas. Like I was saying before, as long as somebody's willing to pay up here, the price will keep continuing to go up. These oscillators are good indications, but they're not absolute. So some of my more veteran traders are kind of have an understanding of what I mean, where you can have an oversold or overbought and an oversold condition, and the price will keep traveling up. That's going to be due to an auction market style of trading. So just kind of mark this off. We're actually in a live market. I mean, a live auction. So we're going to pretend these little lines here are just prices. And we have a person that we call the composite operator, or the big boys, and this is all they're doing. They're going, can I get $10 here, $10 here, 15, 15, 20, 20. Do I got 25, 25, 25, 30, 30? Do I got 30? We get up here to the top, sold to the highest bidder. Then we have the opposite side. We have the sellers. We have someone here saying, I have this product at, $500. Well, we have somebody else that's going to undercut them. Okay, I can get it to you for $450. Continue the same thing, and it's just a process, an outliner that you guys kind of keep in mind to understand what's going on in the market. Now we're going to dive into what we call supply and demand. Supply needs to meet the demand. That's going to be the key thing in the market. Is there's a supply area